You're welcome to another episode of How to Find Buyer Abroad and the Protocol to Find Buyer Abroad on DBA TV. My name is Dele Ayimibo, and thank you very much for stopping by to check out what we have for you today. Today I have another interesting topic for you. I'm sure you have seen it in the caption or on the thumbnail, and that is do this to avoid risk. To avoid risk of not getting paid from buyer abroad. Do this to avoid the risk of not getting paid by buyer abroad. Now, when you are trying to find buyer, there are different payment methods. There are different payment methods. There are different payment methods. If you check online, you will find 4 commonly used payment methods. You have the open account, you have the bill for collection, you have the letter of credit, you have the advance payment. Sometimes you see some other type, bank payment obligations, so many other types. But these 4, common. But out of these, there's a particular one that that most buyer will offer you first. It's called open account. Some people call it cash against document. Some people call it cash against document. The training received by most business owners on payment method in export trade often reveal that the most secure payment method is letter of credit, which is true. But it's also important for you to know that whenever you are looking for buyer, most likely you will be offered a payment method that is most preferred by many buyers, but which portray risk to the seller. And that is called open account. Open account. Many buyers don't want to offer you letter of credit. Why? Because of the cost. And they're asking themselves, how much is it that you're even supplying? Or sometimes, what if you don't supply? How do they recover the cost? So that's what sometimes some people were asking for even performance bond to give a letter of credit. But many of them don't give a letter of credit because trading merchandise goods in the world is almost $22 trillion. Only about 10% or even less than 10% is on letter of credit. About 80%, actually more than 80% of trade in the world is done on open account. So what's open account? What's open account? Open account is a payment method whereby exporter ship the goods, send document to the buyer. Exporter ship the goods, send document to the buyer. The buyer goes to the port to clear the goods and afterwards pay. The buyer goes to the port to clear the goods and afterwards pay. The challenge of this payment method is that the the buyer might not pay. The buyer might fail to pay. The buyer might become insolvent. The buyer might have a fraudulent intent. And there is no cover for you. However, since majority of trade in the world is done on this term, as risky as it seems to be, what you then must do is to ask questions about what do exporters who use this payment method a lot, what do they do to minimize their error rate? Minimize the risk of not getting paid. The payment risk associated with this payment method can be secured using the 3 options of overseas partners. If you have followed me for a while, you will know that I talk a lot about having a representative abroad. Even in this particular series, if you check some of the previous video, you will have seen that I've spoken a lot about having an overseas representative. They are called partners. They can be of 3 types. You can have them as overseas sales representative. You can have them as overseas subsidiary company. You can have them as overseas sales branch. You can use this option of overseas partner to mitigate your risk. And a lot of big exporters, this is exactly what they do. They can afford it. They have representatives, or some of them have a branch, overseas sales branch, or partner with a business, a destination to set up an entity as overseas sales subsidiary who will ensure that payment is made. This affords them to use any payment method. Any payment method. Remember the topic? Do this to avoid payment risk, particularly when you are using open account, because they are going to ask you for open account, cash against document. So the first option you can use or deploy to minimize the risk of open account is having a representative, a partner abroad. In any of the 3 options I've mentioned. Number 2 is to have or use a trade finance instrument like demand guarantee, payment guarantee type of demand guarantee, standby letter of credit, commercial standby type of standby letter of credit. Commercial standby type of standby letter of credit. Some buyers can't give you this kind of instrument, but not for its shipment. They can give you for the shipment for a year, maybe a maximum of $100,000 per time. So anytime you ship, this instrument become a backup for you. So you do the first shipment and they pay. This instrument is not the instrument for payment. They are only activated upon default. So that means if they pay, you do the next shipment and they pay you. You do the next shipment and they pay you. Whenever they are unable to pay for whatever reason, you can call on that standby to get paid. Then when you call on that standby to get paid, they will have to reinstate that standby before you do the next shipment. Or that guarantee before you do the next shipment. Now, the beauty of this is that they will still do the open account, which is very simple and easy with documents sent to them. They can clear without discrepancy or delay. But while they have the simplicity of open account, you also have the security of the guarantee. So you are enjoying the best of 2 worlds. What they want, you are giving it to them. What you want, they are giving it to you. Both of you are happy. You might need to go and read more about this so you can explain to your buyer in case your buyer also does not understand how this instrument works. But let me assure you, their bankers understand it. So if they mention to their banker is going to tell you about the dynamics of how this will work. Another option is if your country or government of your country have this instrument by the Exim Bank of your country, export credit insurance. Export credit insurance. Any of these instruments will protect you. Or you work with the options of partner that I've talked about before. So please, don't avoid open account. Open account risks can be mitigated, so give the buyer a chance by leveraging of this option. So most buyers abroad are going to offer you open account, these payment terms. So as an exporter, you need to put structures in place to mitigate that risk in order to be able to accept that payment terms. Has this video been of interest to you? Has it been of benefit to you? Has it taught you one thing or the other you did not know before that will help you to grow your business? If yes, drop your comment in the comment section. Let's hear from you. Also, if you are just stopping by for the first time, subscribe to this video. Like the video. share with your friends, and remember to click on the notification bell. Till next time, when we come your way again on DBA TV, my name remains Dele Ayemibo, your export doctor, and I'm signing out. Bye-bye. See you in the next video. Bye for now.